There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, and welcome to the COB on this Friday afternoon. I'm Nadine Blaney, and an absolute pleasure to be here with you on a week that we have seen, and I know the last of the day's trades are still running through the S&P ASX 200, but looks like we'll be up about 2.2% for the 5 trading days, so not too shabby overall. And right now, if we take a look at the CIBO Australia, that market has closed higher by about 0.25%, or 4.38 points. So we've got the Australian marketplace, the S&P ASX, up by 0.4% right now, actually. E-minis looking good in the US, up by about 0.25% apiece. And around the region, positivity as global stocks really seem to be looking through this US government shutdown, focusing on rate cuts normally. Today, I would be saying that we are expecting U.S. non-farm payrolls, but of course, because of that government shutdown, they're not coming through. We've seen gold easing slightly from record highs today, but really, right across the region, Asian stocks are set for some pretty solid gains over the week. And that is one of our key themes today. So positivity abounds here in Australia. But as again, I look across the region for our 3 themes, we've got the topics up by 1.4%. Mainland Chinese markets are also doing well, although I must say a kink in that armor coming through in the Hang Seng, which is off by about 1%. Now, when we look at some of our key commodities this week, look no further than oil. So we have been watching the price of oil really closely. I mean, we've seen Kurdish, Iraqi oil coming back to market, but still talking about, again, cuts, production lifts, I should say, coming through from OPEC+. And just breaking news as we've got fire breaking out at Chevron's El Segundo refinery in LA. That being said, though, oil output rising further in September, making the oil price on rocky ground. Now the payroll pause due to that government shutdown, so we'll have to see U.S. markets taking their cue from elsewhere. Tech, let's look at that. It is the strongest sector here in Australia on this Friday afternoon. Up as a whole by 1.7%. Technology One putting on 2.2%. ZipCo up by 2.1%. U.S. Tech did very well overnight. Taking a look at the energy space, that's where some of the weakness is coming through. Energy and utilities together, but Santos down by 2.3%. I mentioned that the gold price did ease slightly. Let's take a look at the impact on some of these Aussie gold miners. Northern Star off by close to 2% to $24.46. In the spotlight today, though, again, Eagers Automotive shares coming back online after the company completed a $452 million equity raise to buy that Canadian company, up by 15, close to 16% shares are today. DigiCo Infrastructure REIT also doing very well, one of the top performers, after signing new data center contracts with government and tech customers as well. TPG Telecom, you heard Juliette, perhaps if you were watching the previous hour, talking about an interview she did with John Lockton from Sandstone about this one. TPG expecting around $600 million in free cash flow benefit in FY25. And Fiducian, I mean, it is a high flyer. I mean, shares have really been doing well, but getting hit today after ASIC claimed the financial services firm's unit engaged in misleading conduct. And AGL late in the session recording 30% proxy vote against its climate plan. That includes Mike Cannon-Brookes' Grok Ventures. And Mesoblast is surging on US Medicare billing approval. MicroX surging after being awarded a $3.3 million order from the Malaysian government, up by close to 27%. And European lithium spiking, an on-market buyback of up to 135 million shares. Meanwhile, EOS, look, it has pulled back a bit after earlier this week hitting a 5.5-year high on a strong revenue forecast. I don't think it's a big surprise to see it falling about 2%. Meantime, Drone Shield, still in that defense thematic, so strong. I'm talking about a drone wall in Europe, and that has helped propel its share price throughout the week, pretty much up by about 12% today to $5.69. It's a Friday, though, and that means that we get the chance to speak with Shane Oliver, Chief Economist at AMP. Shane, nice to see you there. What do you make of market action this week when you consider that we've had a U.S. government shutdown take place? We've got real vitriol between the Republicans and the Democrats on that front. How are markets just looking through this? Shane, are you on mute?
Jeez,
we forgive
like
you.
One of those old lockdown things. I don't know how it got on mute. Anyway, it's a standard conversation you'd have with people when we're on lockdown in Teams, that you'd find yourself on mute and have to get unmuted. But in any case, yes, I mean, it has been a little bit surprising this week. I suspect, though, that markets are saying, well, we've seen these lockdowns before. There's been 20 of them since 1976, and the economic impact is minor. They usually go away fairly quickly, although the last one went for 34 days, and share markets tend to look through it. And I guess the key is here that when workers are sort of have to furloughed in the US, they have to go home or they're not getting paid, then eventually they come back, they've got to do the same work and they get paid, and then whatever was lost in one quarter is made up for in the next quarter. So no lasting impact. And I suspect also that the US share market is taking the view, well, if the jobs market continues to weaken, if Trump lays off all these furloughed workers, then the Fed will just cut rates by more, and that's a good thing anyway. And in the meantime, the overall economy is still doing okay, particularly tech, and therefore we don't need to worry about it. So I think that's sort of what's going on. We've certainly come through the August-September period, which historically have been quite weak, in pretty good shape. US market, Eurozone shares at record highs, Japanese shares close to record highs, or at or close to record highs. And even we in Australia, we had 3 weeks in a row, and then last week we crept up. This week we were up quite strongly. And of course, that's taken us to within, when I was last looking, maybe 35 points from the all-time high, which is not a bad outcome in the great scheme of things. So you might have thought, well, the market would have sold off because of that more cautious attitude, commentary coming from the Reserve Bank. But maybe the markets in Australia are taking the view, well, if the RBA doesn't cut much more because growth is stronger, then that's not necessarily a bad thing in the great scheme of things. So I think that's where we are, but valuation is still a bit stretched. That's an issue. Obviously, there are issues around that shutdown if it goes for longer than feared, so that could be a problem. And geopolitical tensions all still there, worries about the US jobs market. But so far, so good. The market's just climbing a wall of worry.
Yeah, Shane, you kind of brushed over the RBA there. So we did have a hold, as widely expected. But market repricing, the chances of a cut coming through in November, many pushing that out now till February. But can I read through between the lines, I suppose, in your commentary, and that of Michelle Bullock, the governor of the RBA, of course, who pointed to that uptick in activity that we've seen as being a good news story. Like, we're very focused, particularly me as a mortgage holder, on the fact that, we want more rate cuts to come through. But if rates are kept on hold for a prolonged period, that's actually a reflection of a better economy, isn't it?
It may well be. And that's perhaps a scenario that the Reserve Bank could be considering here. That would be a reasonable outcome. You've still got rates at reasonably low levels. 3.6% is historically quite low. It's high in the context of the last decade or so, but in the context of longer term history, it's still pretty low in the great scheme of things. If that's enough to keep the consumer going, business to invest, and the economy to return to better growth rates, then that would certainly be a good outcome, and markets would celebrate that. They would say, well, we've achieved the soft landing the Reserve Bank was trying so hard to do by tracing that narrow path. I guess the flip side would be, well, if rates have to stay here or maybe go up because inflation is more of a problem, then it's a different story. I don't think that will be the case, but that's probably the risky scenario, and that wouldn't be such a good one for share markets, because it would mean that rates have to stay higher for longer because of sticky inflation, which could actually threaten economic growth at some point. But at this point, as Michelle Bullock said, she said, I don't know, in response to one question there. And she also said, I guess, there's no doubt that her comments were a lot more hawkish, consistent with the inflation numbers we'd seen in the last couple of months. But she also said, in response to another question, well, we'll have to wait till the November meeting and decide whether the next move is another on-hold decision or whether it's another cut. So that tells me they've still got a bit of a bias towards cutting. They still think that monetary policy is still a little bit on the tight side, but obviously it's a pretty close call.
Yeah, I think she called it a little bit restrictive or something along those lines. It's amazing that how careful she has to be in her communication. Every word must be thought out, and we're just going to hang on it and bring it up, no doubt, in the future if everything doesn't go as we, want it to go, and that can be a very individual thing. So on that, when you think about this non-farm payroll report being delayed tonight because of this government shutdown, and rates are very much a global market driver right now with expectations of further cuts in the States, where do we look to next, I suppose? Or what might the market be obsessed with next if we don't have this sort of, headline data tonight?
Well, I kind of think that's good, because I don't have to look at the jobs data in the morning. But sooner or later, I'll have to look at it. So in that sense, it's nice going to the long weekend. I've got a new Taylor Swift album to go through. The first four songs, I must say, are pretty good.
Okay.
But and I haven't got through the rest yet. But I don't think it's a disaster. You still get private sector data. We'll still get the ISM, I assume. The ISM services index will still come out. So that'll still come out. And interestingly, there's not a lot of economic data official economic data scheduled for next week in the US. That's just the way the calendar falls. Then I guess it will become more of an issue if we get closer to the next Fed meeting, which I think is on October the 30th. Correct me if I'm wrong there. But if it's on October the 30th, then that gives them, 4 weeks to get those jobs numbers out. And I suspect that by then the lockdown will be over, and then markets can get a good look at it and see what they should price it in terms of money market rates. But I suspect if you look at the run of jobs-related data we've got in the last week, market will, odds are those payrolls were still going to be on the soft side. We saw, Challenger is a private sector outplacement agency. It said that layoffs are still quite low, but hiring is also very low. Then when you look at job openings, hiring, this is according to the JOLTS report, the job openings labour turnover report that came out earlier in the week, they were all fairly soft, consistent with the softening labour market. The ISM manufacturing index had employment remaining in negative territory, and the consumer confidence reading on Tuesday, I think it was, had consumers still less optimistic about the jobs market. Their perceptions of the job market continues to deteriorate. So the overall picture remains of a still slowing jobs market, and I think the payrolls probably would have confirmed that. The big puzzle, I reckon, in the US at present is that when you look at things like personal spending, investment, durable goods orders and so on, overall GDP growth still looks fairly solid, but the jobs data is quite weak. And the big debate is whether the jobs data pulls the GDP numbers down or it works the other way around. And that's going to take quite a while to resolve. But I don't really think that the shutdown, if it just goes for a few weeks, is a disaster in terms of economic flow. But if it keeps going on, if it goes on for into November, then I think it starts to become a lot more of an issue, particularly in terms of that lack of data for markets, but also potentially in terms of the economic impact.
So just quickly, anything that we need to be really across next week here locally?
Well, all we get next week, interestingly, is consumer confidence. This is the Westpac Melbourne Institute measure on Tuesday, and it'll probably be, I reckon, a little bit softer given the on-hold decision by the Reserve Bank and its cautious almost hawkish commentary that the rate cuts may have finished. Then on Friday, we get another update from Governor Bullock, where she appears before the Senate Economics Committee. Now, this one is normally more entertaining than the one she did on September the 22nd with the House Economics Committee, because the people in the Senate don't hold back, and you get some more wacky questions than you get coming out of the House, I tend to find. So it can be more entertaining if you're into watching those things. Tougher gig for the Reserve Bank Governor, though, and Christopher Kent, who also has to show up. But I reckon she's just going to repeat the same message, which is the Reserve Bank is cautious. It may well be that we've seen the bottom. She did say, I don't know. So that could get a repeat at that meeting. Or that testimony, whatever you want to call it.
Now,
probably the thing to watch in the week ahead. But I don't think you're going to get much new out of it.
You know what I always watch? Your LinkedIn, Shane Oliver, because you are quite the star. And I want to know.
Something.
I think I'm a little too young. My kids are a bit too young for me to be a BOMAD. But do you reckon in, I don't know, 15, 20 years, we're still going to be talking about this?
I reckon we will. And it's unfortunately getting worse because, if I go back to when I was in my 20s, yes, there was assistance for first-home buyers, and it was usually in the context of recessions, and they were the people you want to help, to give them a leg up, but also, I guess, to help get the economy moving again, because they typically buy a new property or build a new property. Now, of course, those sorts of things are becoming almost essential. We don't have the grants because it costs the government too much, but we do have these guarantee schemes where you can get in with the 5% deposit and various other things. And it's just made it more and more important for the bank of mum and dad to provide that assistance. The only problem with all this is, of course, that it's a bit unfair, because if you've got a BOMAD, fantastic. But if you don't have a BOMAD, if they don't have the money, you're sort of locked out and you have to struggle a lot more. So I think it's hard to see where this ultimately ends. But I think the focus has to be not so much on more BOMADs, more government guarantees. It's almost like the bank of the government kicking in this week with that 5% low deposit scheme available for virtually all first home buyers, unless you're buying a super duper expensive property in Sydney somewhere or something like that. But that sort of increasing level of intervention to keep the property market going, I think, is a bit of a problem in a longer term sense. But the key to me is supply. If we can get a better balance between demand and get those supply numbers up, that's the answer to all of this. I think these schemes are just a giant distraction, which I guess was the point of that ad there. I certainly don't think it's not quite a Ponzi scheme. People actually have to live in those houses. So I did end saying keep the Ponzi scheme going. But I guess for many Australians, young Australians, it might feel a bit that way.
Yeah, and we don't have time to get into it, nor the Taylor Swift album this time around, Shane. But it's just it just speaks to the inequality, like the fundamental inequality that is at the base of the Australian housing market as well. Because to your point, not everybody has a bank of mum and dad that they can go to, or that is willing and most presently able. Anyways, okay, quick 5 out of 10 for the first 4 songs on Taylor Swift's new album.
Look, only a quick listen. I'd say they're 8 or 9.
Okay.
One of them, the first one, The Fate of Ophelia, I think it's called, and the third one, I forgot the name of it. Father, the one about Father, I think number 4 is also pretty good. Yeah, I'd give them 8 out of 9.
Okay.
I mean, the problem I had with TS, 8, 9, 10, 11. This is TS 12 apparently. TS 8, 9, 10, 11 were all fairly slow and dull albums. I shouldn't say that. I'm a bit of a Swiftie, so I should perhaps be more supportive. But my favourite era was 1989.
Yeah, the fun era.
And Lover.
Yeah.
Yeah, the jump up and down era in style, and You Need to Calm Down. I thought that was the time I really became a fan. The stuff since has been really good, but not on the same level as we had back then.
Yeah.
Whereas what I could see in this new album looks a lot more exciting, a lot more boppy. So that's good. Now, that said, that's just me. I like more boppy music. And I think it was great that Taylor explored these different styles of songs, particularly with the 2 lockdown albums. So that just goes to her strengths, I reckon. But they're just not my favourites.
Yeah.
I'd give them to be really harsh, I'd give them 2 or 3 out of 10. That's just me ranking them. I'd give them 2 or 3 out of 10. Whereas this album, at least the first 4 songs, look up there with Lover and 1989. Although I've got to have a more fuller listen before I can rank them definitively.
Look, there's no judgment here, Shane. Only honest answers, and that's why we bring you back week after week, and why you've been here for decades and such a strong presence in the Aussie landscape. We really appreciate your time as always. I hope you have a good weekend listening to the Taylor Swift album.
I certainly will. I'm almost inclined to go down to JB Hi-Fi and buy one. Maybe I shouldn't be doing plugs for people selling it, but
all the JB Hi-Fi shareholders, just hit the buy button.
But I like to be able to get the CD and see who wrote the songs and who she collaborated with and read the lyrics.
I agree. Like
Spotify is not enough for me.
I know my kids, they'll never know. I was trying to explain to my youngest cassettes the other day, and it was a really difficult conversation to have because the concept was just
I can see some cassettes sitting on my shelf just over there. I've still got some.
Well, one day you're going to have a Taylor Swift book behind you, I bet, as well. All right, Shane.
That's right.
Have a good one. Thank you.
Okay, you too. Thank you.
Oh, I love Shane Oliver. Okay, our stock of the day was the DigiCo Infrastructure REIT. Let's take a listen to what our guests, Junbei Liu from TenCap and Raymond Chan from Morgan's, had to say.
There's easier way to play data center theme. You've got your Goodman Group, you've got your NextDC, and then you've got your Infratel. These names have more established business, and they got lots of contracts, and they all continuously winning contract on a larger scale. So less speculative when it's to do with DigiCo. But regardless, it's a very, very positive announcement for this company.
So specky, but would you weigh in, or what would you do with it?
I would wait. This is way too early. Yeah, one contract win doesn't really mean too much.
Yeah, true enough.
Have a combine of different type of property that allow them to pay a bit of dividend. So it's different. And the share price being a bit weak, well, that's probably understatement since the IPO day. So a bit of relief rally is probably well deserved. Consider the level of short interest I looked last week. So when I look at the short interest on DGT, it's actually cramping up big time. I think the market do not expect today's news. So a bit of relief rally is probably good. However, this is still a very small company, not for everyone. Yeah.
But a buy, nonetheless.
Yeah.
All right, it's a Friday. Let's whip through this quickly. I know everybody wants to start their weekend. Long weekend for some, not us. We'll be here with you on Monday morning, 9:45. Eagers Automotive after that mega buy in Canada. And that cap raise up by 16%, so an endorsement of the strategy. DigiCo, we just talked about it, up by 14%. Big week for Drone Shield, up a further 12% today to $5.69. Those that lagged the market, though, included Boss Energy, Catalyst, Dalrymple Bay Infrastructure, Santos, and A2 Milk. On to the small to mid-cap space of the market, and Finder really doing well today, up by 34%. I'll have to look into that one. Set Tire putting on 27%. Flip the page, though, and there's always the laggards. Steamships trading down by 14% to $12. Challenger Gold off by 10% to 15 cents per share. Tonight, no U.S. non-farm payrolls, as we discussed with Shane Oliver, and we get the ISM Services Index for September. So next week, we get the Melbourne Institute Inflation Gauge, consumer confidence from Westpac. You heard what Shane had to say about that one. The RBNZ interest rate decision, New Zealand has done it tough. Those rates expected to fall. And the minutes from the last FOMC, along with consumer inflation expectations for October. All right, the S&P ASX 200 is closed for business for this first trading week of the new month, and up by close to 0.5%, 8,988 is where this local market finished. U.S. futures still looking pretty good, so we will bring you back to the markets here when we start trading next week. If you've missed anything, though, including the new episode of the Investment Committee, I hope you can make some time over the weekend to catch up with all of the amazing interviews you may have missed. And as well, if you don't receive our weekend newsletter, Off the Clock, Saturday morning, you should sign up for it. We give you the best of the week, plus a little look into what we've personally been reading or listening to or enjoying as well. Look, thanks for joining us throughout the week. I hope you have a happy and healthy long weekend in many cases, and we'll be here Monday.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.